If you're planning to buy a home in the next 6 to 12 months, do this before you look at a single listing. In the next few minutes, I'll show you exactly how to get a real pre approval in Canada without wrecking your credit. The documents, how rate holes actually work, the number one mistake that kills approvals right before closing. You'll leave with a simple 5 step pre approval checklist, clarity on a pre approval versus pre qualification, how the mortgage stress test fits in, and what to avoid so your approval doesn't fall apart. Before we dive in, I'm Dion Williams with Williams Mortgage. I work with Canadians all across the country helping homeowners get mortgage free faster. That's what I do. If you want to chat, click the link below and book straight into my calendar. And while you're at it, hit that subscribe button so you don't miss any updates. Let's clear the biggest confusion fast. That label isn't what matters. Quality is. A real pre approval means full application review, a soft credit pull to check your score, your debts, and your utilization. Income and down payment documents verified. A pre qualification is based only on what you say verbally or typed in a calculator. It's not reliable. Why? Because your income is how your income matters is or structured matters. See, you can have salary versus hourly. You can have guaranteed hours. You can have overtime hours. You can have bonus history. And self employed, we can do add backs. All of these change what you actually qualify for. Bottom line, verification is everything. If nobody asks for docs or pulls your credit bureau, you don't have a true ceiling. We start with a full application and a soft pull of your credit, so you see where you stand without a hard hit. This helps spot quick wins, pay down opportunities, utilization fixes, or any errors that you may be able to dispute. We also map your debt to service ratios against the mortgage stress test, qualifying at a higher rate of the benchmark rate of 5.25% or the contract rate plus 2%. Here's what you'll need. If you're employed, meaning salary or hourly, we'll need an employment letter, a position with start date, and recent pay stubs. If you have variable hours, we can look at overtime and bonus income. We'll also need 2 years worth of T4s and NOAs or payment history to support averages. If you're self employed, we need 2 years of T1 generals and no NOAs. Business financials could be required as well. In terms of down payment and closing funds, we'll need 90-day bank statements for sourced and seasoned funds, such as RRSPs, FHSAs, or TFSA statements if you're using them. If it's a gift, we'll need a gift letter plus deposit proof. You're probably asking why so thorough? Because lenders and insurers need to know how the numbers work and what's behind them. This is where a flimsy pre approval falls apart later. We translate your verified numbers into a max purchase price range, monthly payment at different rates and different terms. Estimate closing costs typically between 1.5 to 4% of the purchase price. And then there's rate holes. Rate holes are typically about 120 days. And this protects you if rates rise. If market rates are lower at the time of offer, we use the lower rate. Your pre approval amount can still change if your situation changes. More on that in a moment. If your mortgage is insured, meaning you put less than 20% down, there's 3 companies that look at your file: CMHC and Sagen and Canada Guarantee. Now, your pre approval is based on the lender's rules first, and the insurer signs off on that at a live deal. With 20% or more down, that's what we call uninsured. We still fully verify everything, but the property details like an appraisal and marketability can also influence your appraisal later. Curious, what part of the pre-approval stresses you out the most? Is it documents, credit, a stress test? Drop in the comments. I'd really like to know. Now, in terms of timeline, usually you want to start 6 to 12 months before you plan to buy. If credit or savings need work, that cushion lets you fix it without pressure. If you renew, you can have your rate hold 120 days if you're still shopping. This keeps the file warm. If your income changes, or you move jobs, or your down payment sources change, update us immediately so your numbers can stay accurate. Do not take on new debt after your pre approval, like a new car, furniture financing, high balances, or opening new credit. Any of these can bump your ratios and tank your approval. Avoid large unexplained deposits and keep a paper trail for every dollar used for your down payment and closing. Don't switch jobs or move to probation without telling us first, especially if you're moving from a salary to a variable income. So here's your 5 step checklist. Number one, real pre approval equals application plus a soft pull and document verification. Two, provide income docs plus 90 days down payment. Three, understand the stress test, closing cost, and get a rate hold. Four, renew holds and update changes immediately. And five, do not add new debt or make undocumented deposits. If this helped you, hit that like button and hit the subscribe bell. And if you want to book a call with me or someone from my team to take a look at your scenario, restructure payments, or see if you can pay off some debt, click the link below in the description. You can book directly into my calendar and we'll meet on Google Meets. Thanks for watching.